So financial accounting. Previous class, we covered chapter 7 relating to non-current assets. We have covered non-current assets, what cost should be capitalized, what should be treated as expense, mean revenue expenditure, capital expenditure. And we have covered depreciation. There are two methods of depreciation, straight line and reducing balance method. Okay, chapter 8 is also about non-current assets. But here we will discuss about the disposal of non-current assets and revaluation of non-current assets. What is disposal? Disposal means either sale or exchange of asset. And if we are selling any asset, that will be called disposal of asset.
Like in scrap also.
If we are exchanging old asset with a new asset, that will be called disposal of asset. Let's discuss about sale. Suppose we are having a asset cost, say 100,000. Its accumulated depreciation is say 40,000. What is this 60,000? It's carrying value. 60,000 is carrying value. Suppose we have disposed this asset by 70,000. What is this called? Sale proceed. The amount we are receiving against disposal will be called sale proceed. Mean cash received. By selling the asset, we received 70,000. Carrying value is 60,000. What is the worth of asset at the time of sale? 60,000. But we have sold for 70,000. So 10,000 will be profit. Is that fine? But if suppose carrying value is 60,000, we have sold for 52,000. It's been asset worth is 60,000. We sold for 52,000. So 8,000 is the loss on disposal. When we are selling any asset, we need to open 3 different accounts. One will be called asset cost account. Other will be called accumulated depreciation account. Asset cost account is always having a debit opening balance. Balance brought down, that is say 100,000. Accumulated depreciation is always having credit balance. So its brought down balance will be 40,000. Its nature is credit. If we add any asset during the year, we record addition here. But if we are disposing, selling any asset, that will be recorded here. In credit side. Accumulated depreciation account, if we charge current year depreciation to the profit and loss account. What is depreciation, expense or income?
Expense.
Expense. And in profit and loss account, expenses are debit, income are credit. This means profit and loss account is a debiting. Against it, accumulated depreciation will be credited. Profit and loss. Is a fine. So when we are disposing any asset, we need to open an account called disposal account. While disposal, what we need to do, we need to eliminate this asset from asset cost account. How we can eliminate? We will credit the asset and we will charge to disposal how much? The complete 100,000. This means if asset cost account is a credit against disposal, disposal account will be debit against asset
Cost account.
100,000. At the time of disposal, we need to eliminate depreciation of that asset. And this asset we are disposing, what is his depreciation? 40,000. How we can eliminate depreciation? By debiting the accumulated depreciation account against disposal. How much? 40,000. So disposal account will be credited with 40,000 against accumulated depreciation account. Is it fine? The cash we received at the time of disposal, how much we have received?
70,000
70,000. Is cash coming or going out?
coming inside.
This means cash will be debit, disposal will be credit.
Disposal
What amount? 70,000.
70,000.
And what we will do then? This account is tally finished. Now we need to tally disposal account.
Disposal
Which side is bigger, looking bigger, debit side, credit side?
credit side.
Credit side is showing how much? 110,000. So we'll write 110,000 and there will be balancing figure of how much? 10,000.
Profit and loss.
This will be charged to profit and loss account. And in profit and loss account mean if disposal account debit, profit and loss account credit. What credit to profit and loss account, income or expenses?
It's
Income.
income.
So we will call it a profit on disposal.
Profit on disposal.
If balancing figure coming on the credit side,
Loss.
we will call it loss on disposal. Can you understand this?
Yes.
Now, if we move towards counting entries,
Balance sheet.
first entry, we will record debit disposal with how much? 100,000. And we will credit what? Asset cost account, 100,000. We need to eliminate asset from the asset cost account. Then for elimination of accumulated depreciation, we will debit accumulated depreciation with 40,000 and credit disposal with 40,000. Now we need to record the cash coming in. So we will debit what cash? How much? 70,000. Credit what? Disposal. With how much amount?
70,000.
No. This 100 minus 40.
60,000.
60,000. So the remaining 10,000 should be recorded on debit side or credit side?
Debit side in this.
Debit side we are having 70. Credit we are having 60. To make it equal, we will credit 10,000 and that will be called profit on disposal. If we need to record something on the debit side, that will be called loss on disposal. So these are the accounting entries that we need to pass for disposal, means sale of asset. Let's discuss these first, then we will move towards what is exchange. So disposal of asset is of two type, either cash disposal, mean we are selling the asset, or part exchange, mean exchange of asset. So disposal of non-current assets, the carrying amount of an item of property, plant and equipment mean asset shall be de-recognized on disposal. Mean we need to eliminate the cost account when no further economic benefits are expected from its use or disposal. And if sale proceed are greater than carrying amount, there will be profit. Like sale proceed are 70,000, carrying amount was 60,000. So there will be profit. If sale proceeds are less than disposal, Mean carrying amount is a 60,
3,000.
while we receive 50, there will be loss.
Now,
If both are equal,
neither profit nor.
so there will be no profit nor loss. A disposal T count is required when recording the disposal of non-current asset. This is a profit or loss account. To calculate profit or loss, we need to open disposal account. And what could be the entry? Disposal account debit, asset cost account credit, accumulated depreciation account debit, disposal account credit, cash debit, disposal credit. If there is difference, that will be profit or loss. Test your understanding one. Pat runs a landscape gardening business. On 1st February 20X, on 1st February 20X2, Pat purchased a sit on lawn mower costing 3,000. He purchased an asset on 1st February 20X2 with 3,000, which is depreciated at 10% per annum straight line on a monthly basis. So what is the per year depreciation?
Per year, definitely 300.
300. How we have calculated 3,000 into 10% is equal to 300 per year. On monthly basis, this means we need to charge depreciation on pro rata basis. Pat decided to replace it with one which has an enclosed cabin for use when it rains. The lawn mower was sold to an old friend for 2,000 on 31st July 20x5, and he sold on 31st July 20x5 for 2,000. How many years he has used? 20x2 he has used, 20x3 he has used, 4 he has used, even 7 months of 5 he has used.
Yeah.
How much is total charge to Pat's statement of profit or loss relating to the asset sold for year ending 31st December 20x5? You need to calculate what amount should be charged to profit and loss account, either profit or loss. This means we need to calculate its carrying value first.
Yeah.
So asset cost was 3,000 and depreciation for 20x1,
Yes.
20x2, sorry, 20x2 depreciation
On 11 months.
11 months. So 300 into 11 by 12, 275. For 20x3 depreciation will be full year.
300.
For 20x4 depreciation will be for full year 300, and 20x5 depreciation will be 7 months.
7 months, 125.
7 by 12, it's 175. So all together, if we check what is carrying value, what is the total accumulated depreciation?
1,050.
1,050. So what is the carrying value? What is the carrying value? 3,000 minus 1,050.
Yeah, 3,000 minus 1,050 is equals to 2,000. 1950.
So 1950 is the carrying value, and he has sold for 2,000. This is proceed. So proceed greater than carrying value. So there is a
Profit.
50 profit. So this means to profit and loss account, what will be charged? This 50
Yes.
profit of 50, and the depreciation for the current year.
It's 1,050.
No, for the current year 175. So depreciation
175.
for 20x5 will be 175. So these two figure will be charged as expense and income to the profit and loss account for 20x5. Is that fine? Now we are moving towards if we are disposing asset, not sale, through part exchange. Mean we are exchanging. Suppose asset cost is 100,000. Its accumulated depreciation is 40,000, and we are having a carrying a value of 60,000. Now we are exchanging this asset of 60,000 with a new asset. And a new asset value is say 70,000. So what's the difference between these two? 10,000 we will pay cash for 10,000. We'll pay 10,000 cash. Now the new asset value will be 70,000. The new asset value will be 70,000. What we will record for this? We will record two accounting entries: debit new asset, credit disposal. One entry we will record this.
Should we record like disposal or exchange?
Disposal is 60,000. So we'll record a new asset 60,000 first entry, and then we will record a second entry, debit new asset,
10,000. Credit
credit cash. How much cash we have paid? 10,000. 10,000 all together. New asset will be debited with 70,000. Enough. Is it fine?
Yeah.
Mean we need to record disposal with carrying amount. If suppose our asset carrying value is 60,000, but the exchange party say, no, I will take your old asset with the worth 50,000. Mean disposal value is what? 50,000. This means we are eliminating asset of 60,000. But he is considering it 50,000. This means if we are taking 70,000 asset, how much cash we need to pay? 20,000. So we'll record this entry with 20,000, disposal with 50,000, and this entry will be recorded with 20,000. Is that fine? But our asset carrying value is 60,000. So we will record disposal with 60,000. So remaining 10,000 should be on debit side. What is this? Loss on disposal. Because we need to eliminate asset at what amount it is in our book. It is in our book is at 60,000. So we need to eliminate whole 60,000. This means if we new asset for cash is 20,000, so remaining 50,000 will be against disposal. So the difference we will record either gain or profit. If the exchanger says, okay, I will take your 60,000 asset with 65,000. More. This means we need to pay cash how much? 5,000. So what we will record this 5,000 extra as profit on disposal. So let's discuss. That's your understanding too. Sanyu runs a business altering and repainting clothes. When Sanyu started business on 1st January 20x2, a Supastitch 2 swing machine was purchased at a cost of 2,500. So in 2002, 1st January 2002, he purchased a machinery with 2,500 cost. Swing machine are depreciated using straight line method at 20% per annum. So what is the depreciation per annum? 500. The full year of depreciation is charged in the year of acquisition and none in the year of disposal. Me no pro rata. They will charge full year depreciation in year of purchase, but no in disposal. The business has now grown such that Sanyu need a faster machine and will upgrade to the Super Stitch 5 during December 20x5. He is moving towards fifth model rather than second model. When in December 20x5. The Super Stitch salesperson has offered a part exchange deal as follows. Part exchange allowance for Super Stitch is 750. Mean they will take your machine with the value of 750 and balance to be paid in cash for Super Stitch of 4850. What you need to do, you need to show the ledger entries for the year ended 31st December 20x5 to reflect this transaction. Accounting entries you need to pass. First, we need to see what is the carrying value of asset at 31st December 20x5. So its cost was 2500. For 20x2 depreciation is 500. For 20x3, no, complete year depreciation in year of purchase.
Complete year depreciation of for 20% rate is 125.
No, 2500, 20%, 20% of 2500 is what? That 2500 into 20%. Is that 125? I think so, 500. 2500 into 20 by 100. 500. For 20x3, 500. 20x4, 500. And 20x5, no depreciation because it's the year of disposal. So carrying value is what? 1000.
Yes.
But they are taking at 750.
Loss.
There's a loss of how much? 250.
250.
This means the first entry will be debit new machine. We can say new asset.
Asset.
Credit what? Disposal. So our asset of 1000 is going, but they are considering it at 750. So with the 250, we will debit what? Profit and loss account loss. Because that will be debited to profit and loss account. And then we need to record debit new asset. Credit what? Cash with how much amount? 4850. So this loss will go into profit and loss account. What else will go into profit and loss account? Depreciation for the current year.
For the new asset,
For the new asset.
but it's not mentioned.
But we need to charge depreciation. Every asset should be depreciated over its useful life.
But
And the depreciation rate will be same 20%.
same for the new asset.
So what is the value of new assets? 4850 plus 750 will be 5600. And we will depreciate how much? 20%.
20%.
So what will be the depreciation? 1120 depreciation for 20x5. This will also go, and loss of 250 will also go into profit and loss account. But he asked for accounting entries. This means for 20x5, we need to record accounting entry debit depreciation 1120 credit accumulated depreciation 1120. Is that fine? Is that fine?
Yes, sir.
Can you understand this?
Okay. Sir, like this type of questions, it will be MCQs, right? Like there will be given values we have to do and that's a
Exactly. Or they can ask calculate the value of loss or profit. So this is about exchange. Now we are moving towards the revaluation of non-current assets. Companies having a option, either they can record their asset, mean non-current asset, on a historical cost basis, or revaluation basis. Historical cost basis mean simply that what we have learned till now, that is historical cost basis mean cost less accumulated depreciation, they will record on carrying value. If companies see, no, my asset market value is more than their carrying value, so that market value is called revaluation value. So they can record their asset on market value. So they are having option, either they can adopt a cost basis, either they can adopt revaluation basis. But if they have chosen revaluation basis, then all asset in the same class should be revalued. Then all asset in the same class should be revalued. How to record asset on revaluation basis? Suppose asset cost is 100,000. Its accumulated depreciation is 40,000. What is the carrying value? 60,000. Suppose asset market value is 70,000. The difference, what is the difference? 10,000. We will call it revaluation surplus.
If it's more.
If it's more. Revaluation surplus. Now we will record our asset with this value. And we will record accounting entry debit asset credit revaluation surplus. How much is the revaluation surplus?
70.
Now surplus only 10,000, and asset will be added with the revaluation 10,000. So in your book, asset was having 60,000. Now you are adding 10,000 more, so asset will become automatically year-end 70,000. This is the accounting entry to record revaluation surplus.
What if the market value is?
We're gonna discuss. Now suppose if carrying value is 60,000 and its market value is 50,000. In market value is low, that 10,000 will be called revaluation loss. Because if company have chosen revaluation policy, then he need to record all asset on revaluation basis. They cannot say, okay, where is gain, we will record on revaluation, where there is a loss, we will keep on cost basis. No. If you have chosen revaluation, you have to record all asset on revaluation. So this means asset value has gone down. So we will credit asset by 10,000. And debit, we will record loss where profit and loss account. 10,000. Revaluation gain cannot be recorded in profit and loss account.
It will be recorded in.
It will be recorded in revaluation surplus called other comprehensive income. Will not be recorded in profit and loss account as profit, as gain. But if there is a loss, that must be recorded in profit and loss account as loss.
And
The revaluation gain will not be recorded in profit and loss account, but revaluation loss will be charged to profit and loss account. Is the fine?
other company.
So let's discuss. We need to read this. So far, the focus has been upon accounting for the cost of an item of property, plant, and equipment and the associated requirement to account for depreciation. According to IAS 16, items of property, plant, and equipment can be measured and accounted for using the revaluation model. Some non-current assets such as land and building may rise in value over time. Company rather than sole trader or partnership may choose to reflect the value of the asset in its statement of financial position. This is known as revaluing the asset. Mean you are increasing the value of your asset. IAS 16 says that if an asset carrying amount is increased as a result of revaluation, instead of 60, it becomes 70. The increase shall be recognized in other comprehensive income and accumulated in equity under the heading of revaluation surplus. This will be covered later in this next. This gain is not recorded in statement of profit or loss account as it is unrealized because we haven't received the cash. That's why it is unrealized. Only realized gain should be recorded as a profit and loss account. Think about owning a house. The value of this house may appreciate in value over time. You cannot go out and spend that increase in value on a new car through because it is not a real gain to you. Then this is unrealized gain. You haven't received anything against it. It only become real when you sell the house and receive the benefits for that sale. Mean gain will be realized when you receive cash against it. Until that point, it is a hypothetical gain, how much you would gain if you sold it at that point in time. So don't forget the house could fall in value again by time you sell it, leaving you to find other ways to fund the car, just agree to buy. Mean if you haven't received the cash, that gain will be called unrealized gain. So you cannot charge to profit and loss account because in profit and loss account, we only record realized gain rather than unrealized. Okay. As this increase in value represent the unrealized gain, we cannot record it as profit of the part of profit earned during the year. IAS 1 requires that revaluation gain are disclosed separately from profit in other comprehensive income. This will be covered in later chapters. So illustration 1. Vanguard owns land which originally cost 250. No depreciation has been charged on the land. IAS 16 says land is excluded from depreciation. Why? Because its life cannot be determined. Land is having indefinitely. That's why it will not be depreciated. If suppose we are having land and building, its value is say 100,000. If we can differentiate what is the amount of land, what is the amount of building, suppose land value is out of this 40,000 and building value is say 60,000 and 10% is depreciation rate, we will depreciate only the building part. Mean depreciation will be 60,000 into 10%, how much? 6,000. Land part we will not depreciate. Suppose they have given you land and building value of 50,000, but what is land, what is building, it's not differentiated. And depreciation rate is 10%. Then we will charge depreciation on the complete amount. If land part can be separated, then we need to charge depreciation on the building part. If there is only land, no depreciation.
Uh, uh, Depreciation rate, it depends upon the life. Like
It
if
depends
it's a
upon the
10
life.
years life, it's 10%.
10%, 5-year life, 20%, 3 years life, 33%, like that. So whether on land which originally cost to 50,000, no depreciation has been charged on the land in accordance with IAS 16 standard allow. Whether wish to revalue the land to reflect its current market value, which it has been advised to is a 350,000. So what is carrying value is 250. So what is the market value is 350. So what's the difference? 100,000. What is that? Revaluation surplus. How is this reflected in financial statement? Debit. What? Land. With how much? 1,000. Credit what? Revaluation surplus with 100,000. Is that fine?
Yeah.
Okay. Now moving further. Now we are moving towards illustration 2. If asset is a depreciable asset, what could be the accounting entry? In that case, debit, asset, credit, revaluation surplus, that was the entry of a revaluation. If the asset is depreciable asset, mean other than land, in that case, we will debit asset, we will debit accumulated depreciation and credit revaluation surplus.
Okay, we have to record.
How? Let's see. How? Let's see. This example. Hamstrung runs a kilt making business in Scotland. It has run the business for many years from a building which originally cost 300,000 and on which 100,000 accumulated depreciation has been charged to date. This means cost was 300,000 and its accumulated depreciation that we charged was 100,000. So its carrying value is 200,000. And we need to compare market value with carrying value. Hamstrung wished to revalue the building to 750. And what is market value?
750,000.
So what's the difference?
550,000.
550,000 is what? Revaluation surplus. 550,000 is revaluation surplus. What we need to do? We will record accounting entry. Valuation surplus will be credited with the 550,000. Accumulated depreciation means that as a depreciation whole we will eliminate. As we eliminate in disposal, we eliminate here as well. How much was the depreciation? 100,000. So we'll debit the asset with the remaining difference. What is that? 450,000. Is that fine?
Or if the consumer revaluation surplus is
Revaluation surplus will be credited with whatever is the revaluation surplus, and we can calculate revaluation surplus how? Carrying value against market value we need to compare. We need to compare carrying value with market value. So market value is a 750. Carrying value is 200. So difference 550 is revaluation surplus.
Now the asset value is 450,000.
Asset value is a 450,000. Is that fine?
Yes.
Okay, let's see. So they have prepared the ledger as well. Like asset we bought with the 300,000.
Revaluation surplus.
So revaluation surplus asset is debited with the 450,000 altogether. Asset account will be showing 750. Its value now, market value now.
Yes.
Ultimate depreciation was having 100,000, so we have eliminated it. And revaluation surplus
Non-current.
450 asset, 100 is that. So carrying value 550 will be revaluation surplus balance. Is that fine now? Okay. That's your understanding 3. Try by yourself. That's your understanding 3. Try by yourself.
Four 400,000.
So Max company owns a fish finger factory. The premises were purchased on 1st January 20x1 for 450 and depreciation charged at 2% per annum on a straight line basis. So what is the depreciation per annum? 9,000. Mac company now wish to revalue the factory premises to 800,000 on 1st January 20x7. This means 450 was cost. So
9,000 was depreciation.
So for 20x1, 9,000 depreciation, 20x2, 9,000 depreciation, x3, 9,000 depreciation, x4, 9,000 depreciation, x5, 9,000 depreciation,
X6.
and x6, 9,000 because start of.
On 1st January.
So what is the depreciation for these 6 years? 5,400?
Yeah, 54,000.
54,000, 54,000. So what is the carrying value? Carrying value is
396.
396,000. So they are market value is
800.
800,000. So difference is
400.
404,000. So that is a revaluation surplus. What they have asked? They have asked for revaluation surplus. That's fine. See, so So sadly, you have the previous exposed cost was 2000 this mean depreciation was rate at 10%. This mean 10,000 we charge depreciation of the value becomes 300,000. Now, regarding 30,000, how much more we are charging depreciation?
20,000.
For this 20,000, we need to record an accounting entry every year, now onward. Condition first now we charge that is just the credit retained retained with the 2000. We have and we record that using our because we can now we are getting more depreciation here. More for that now we will record the entry which is stabbed in a mistake. So we are crediting and exclude values. So this high inflation, higher the valuation and will be tied to loss as normal. Like yes, 16 says that if item property plant and equipment is revalued, the entire class of property plant and equipment to which that asset belongs shall be revalued. I think permits a class of asset to be revalued on a rolling basis. So for extra depreciation, the excess of new annual depreciation charge over the old depreciation charge, like 20,000, may be the subject of an annual transfer from revaluation surplus to retained earnings. For this, we need to record accounting entry, revaluation surplus debit, and retained earnings credit. Illustration 3. Try by yourself.
We have to provide that entry for like revaluation surplus and retaining.
Exactly.
That's
To extra depreciation.
the extra depreciation is 30,000, sir.
Let's see. So what accounting entry should be made in the financial statements? Asset owns a retail unit in central Springfield. It bought the property 25 years ago for 100,000, depreciating it over 50 years on a straight line basis. At the start of 2006, the entity decided to revalue the unit to 800,000. So cost was 100,000 and 25 years depreciation. How we can calculate per year depreciation? 100,000. There was no residual value divided by 50 years. It will become 2,000. So 2,000 into 25 will become 50,000. So carrying value is 50,000 and we are market value is 800,000. So there is a revaluation surplus of 750,000. The unit has a remaining useful life of 25 years. At the date of the revaluation, it is entity's policy to make the annual transfer of excess depreciation between revaluation surplus and retained earning with the equity. So now the value is 800,000 and remaining useful life is 25 years. So what is the depreciation now? 32,000. Before it was 2,000, now 32,000. So extra depreciation is 30,000. So we need to record accounting entry. So debit asset, debit accumulated depreciation and credit revaluation surplus with 750 and accumulated depreciation is 50,000. So with the 700,000 we will record asset. And for the current year depreciation, debit depreciation expense, credit accumulated depreciation, and that will be 32,000. And for extra depreciation, we will record the accounting entry debit revaluation surplus with 30,000 and credit retained earnings. 30,000. So these accounting entries we need to pass. This is the revaluation entry. This is the current year depreciation entry. And this is for elimination of extra depreciation. So in the similar manner, if we are disposing revalued asset, we will charge gain or loss, profit and loss account. The gain or loss arising from derecognition of an item of property and plant and equipment shall be determined as the difference between the net disposal proceed, if any, and carrying amount of the asset. The revaluation surplus included in equity in respect of an item of property, plant and equipment may be transferred directly to retained earnings when the asset is derecognized. If we are disposing any revalued asset at the time of disposal, what is the balance in revaluation surplus that will be transferred to retained earning? I mean, we will record entry again, debit revaluation surplus, credit retained earning. Like in this previous question, revaluation surplus, we credited 750. Out of this 750, 30,000 we have eliminated. So what's remaining? It is having 720. If suppose we are selling this asset, with that 720, we need to record this entry again. Revaluation surplus debit, retained earning credit. So that revaluation surplus should be fully eliminated. So when we need to record this entry, Revaluation surplus debit retained earning credit in case of extra depreciation and in case we are disposing the revalued asset. That's your understanding for. Tiger Trees owns and run a golf club. Some years ago, the entity purchased land next to the existing course with the intention of creating a smaller 9-hole course. Cost of the land was 260,000 and it will not be depreciated. Over time, the entity had a land revalued by 60,000, 600,000. So carrying value is 260,000. So market value is 600,000. So with the 340,000 is a revaluation surplus. It has now decided that building the new course is uneconomical and has sold the land for 695,000. Now they are selling the land for 695,000. What's its value? 600,000. If they are selling with 695,000, so what is the 95,000? That is gain on disposal. What accounting entries are required to reflect the disposal? So debit, credit, asset will be gone with the 600,000 and disposal will be credit with the 600,000. Is there any elimination of depreciation?
Yes.
Oh,
No
so that
depreciation, but from gain.
debit cash,
Credit cash.
how much? 695,000. So credit what?
Gain.
Disposal.
Disposal.
What is disposal having? 600,000. So what should we credit?
Gain on disposal.
95,000 should be on credit side with the gain
Yeah.
on disposal that should be charged to profit and loss account. And revaluation surplus was having 340.
Yes.
So debit revaluation surplus to eliminate this credit 340. And this will be charged to which retained earning.
340.
So these accounting entries should be passed for this
To settle the revaluation surplus account, we have to pass the
accounting entry
account.
because this asset is gone. So revaluation surplus relating to that asset, we should also eliminate from the books. So this chapter is ended. No, not ended. IA 16 is relating to non-current assets, tangible non-current assets, and tangible non-current assets called PPE, property, plant, and equipment. IA 16 require you need to provide disclosures in the financial statement relating to your assets. What disclosure you need to provide? You need to disclose the carrying value, how you calculated it. The depreciation you are charging to profit and loss account should be disclosed. And what methods or rate you have choose for depreciation should be disclosed. And if there is any revaluation gain or loss, you need to disclose it as well. IA 16 property, plant and equipment, there are a number of disclosure requirements relating to non-current assets. The measurement basis used for arriving the carrying amount of the asset cost or evaluation basis, you have to disclose either you are recording asset on cost basis or evaluation basis. If more than one basis has been used, the amount for each must be disclosed. Depreciation method, its useful life, depreciation rate should be disclosed. The gross amount of each asset heading and its related accumulated depreciation should be disclosed. And reconciliation of the carrying amount at the beginning and end of the year mean its addition. Its disposal, revaluation must be disclosed. Mean what, how company can disclose asset like this? Like suppose companies having four type of asset: land and building, plant and equipment, motor vehicle, fixture, and their total. First, you need to disclose cost account balance. Profit balances mean opening balances.
Opening balance.
Addition during the year,
Revaluation in year.
revaluation during the year, and disposal during the year, closing balances for all the asset and the total.
Depreciation.
Then you have to disclose accumulated depreciation account opening balance. Depreciation charge during the year mean profit and loss account figure. And at the time of revaluation, you debiting accumulated depreciation. And at the time of disposal, you are debiting accumulated depreciation, mean eliminating those and their carrying value. And this value A minus this value B, you will calculate this C. A minus B. Carrying value for the current year. And you have to show the carrying value of previous years as well. Carrying values of current year and carrying values of previous year as well. So this chapter is completed now. Let's discuss 2-3 difficult MCQs from KIT. And then we will finish for today. MCQ number 121C. 121. Let me copy this from here. So, the non-current asset register shows a carrying amount of non-current assets of 85,600. Mean company maintain asset register as well as cost account balances. So asset register is showing the balance of what? 85,600. The ledger account include a cost balance of 185,000 and an accumulated depreciation balance of 55,000, while a ledger balance showing a cost of what? 185,000 and accumulated depreciation is what? 55,000. So what is the carrying value? 130,000. While asset register and ledger should show same balance. But here it's not showing the same balance. There is a difference of what? 85,600, 130. What is the difference? What is the difference? It's 44,400. I think so. Okay. Which of the following statement may explain the discrepancy? Mean why there is a difference? Either there is something omitted here, or either there is something recorded more here. Or not. Might be there is something recorded in ledger but not in asset register. Okay. A. The omission of an addition of land of 30,000 from the ledger account. Mean there is 30,000 omitted from the ledger. This means if we add this 30,000 to the ledger account will become even more. This means this is not the option. We could say there is omission from asset register.
We can add.
Yeah, we can add and make the balance equal. But if there is omission from ledger account, so it will become even more, the difference will become even more. So this is not the option. The omission of the revaluation of an asset upward by 16,600 and revaluation where we record the entry in asset ledger. Now ledger. What is the accounting entry? Asset cost account debit, accumulated depreciation account debit, revaluation reserve credit. So this will even increase the difference in ledger. What is C? The omission of the disposal of an asset from the ledger account of 25,600. Yes, we could say there is omission of disposal. Disposal is 25. Mean this should be reduced from the ledger account. And accumulated depreciation at disposal of 11,200 for that asset. So there was an asset disposed with 25,600. That accumulated depreciation was how much? 11,200. How much is the carrying value? Because we are maintaining carrying value of a ledger. 13,400. 13,400. This means this 13,400 should be eliminated from this. Then this will reduce as well as and an omission of addition of land costing 30,000 from the register. And in register, what is not recorded? 30,000 land is not recorded in asset register. So if we record this, this will become how much?
It is 1,215.
600.
This is 14,400.
This is 14,400.
Yeah.
And if we deduct 14,400 from this, is that will become this amount, say 115, 600.
Yeah, 115, 600.
So this is looking fine. I mean, this will tally both things. What is D? The omission of an upward revaluation by 16,400 from the register. So if we add 16,400 to the register, that will become 85,600 plus 486 and plus 16,102,000. And the accidental debiting of depreciation charge of 28,000 to accumulate depreciation ledger account. More if we deduct 28,000 from other side.
It's 1,120,000.
So it will not tally.
Yes.
So what's the correct option?
Option C.
Option C.
It's a twisted questions.
It will take time while sitting in the exam. Let's move towards next. Lorry bought an asset on 1st January 20x4 for 235,000 and depreciated it at 30% using the reducing balance method. On 1st January 20x7 mean after 3 years. Lorry revalued the asset to 300,000. What accounting entry should a Lorry post to record the revaluation? Can you try this? What should be the accounting entry? What should be the accounting entry? Debit asset, debit accumulated depreciation, and credit revaluation surplus.
Plus
But we need to calculate. Asset cost is what?
cost is 230.
235,000. 20x4 depreciation will be what? 30% of 235,000. What is that? 70,500. If we deduct, we will arrive at carrying value of what?
164.
164,500 for 20x5. Depreciation will be 30% of 164,500.
49,350.
49,350. If we deduct, we will arrive at carrying value of
115, 150.
115,
150.
150. So for 20x6, we will record depreciation at the rate of 30% of 115, 150.
34, 545.
34, 545 will deduct, we will arrive at carrying value of
80,605.
80,605. So market value is what? 300,000.
300,000.
So what is the revaluation surplus? What is the revaluation surplus? 219.
395.
395. So revaluation surplus will be 219, 395. So what is the total depreciation? Add these three depreciation.
154, 395.
154,
390.
395. So remaining is the asset value, and that is what?
The value is 154, so 1.
19395 minus 154,395.
153. 55,000.
So what is the accounting entry?
Option C. Debit revenue.
Option C saying debit revaluation surplus. This is never ever.
No, some credit.
Option D is also saying debit revaluation surplus. Never ever.
Credit revaluation surplus.
A saying debit asset with 65,000, accumulated depreciation with 154, and
Credit.
so A is
Option
okay.
debit credit.
Now moving towards next MCQ.
Mind is getting doubled.
Which of the following statement is true in relation to the non-current asset register? It is an alternate name for the non-current asset ledger account. No, ledger account is separate, register is separate. It is a list of physical non-current assets rather than their financial cost. No, including their cost.
Including their cost.
It is a schedule of planned maintenance of non-current assets for use by plant engineer. No.
No.
It is a schedule of the cost and other information about each individual non-current assets. Yes, option D is the correct option. In 126. Oh, sorry. Image and paste it here. Okay. What should be the charge for depreciation in CC's statement of profit and loss account for the year ended 31st December 2026? We need to calculate depreciation for 31st December 2026. The plant and equipment account in the records of C company for the year ended 31st December 2026 is as follows. Plant and equipment at cost, this is the opening balance. During the year, there is addition of 48,000. This means we need to charge its depreciation from 1st July onward. How many months? 6 months. There is a disposal of 84,000. This means for this asset, depreciation should be charged for 9 months only,
9 months.
not for full. And company policy is to charge straight line depreciation of 20% per year on a pro rata basis. So the asset coming from previous year, how much is that? 960?
960.
Should we charge the depreciation complete 960?
Full year.
No. Out of this 960, 84,000 is sold.
Sold.
So this means 960,000 minus 84,000. How much is that?
876,000.
876,000. We need to charge depreciation at 20% on it. What is that?
175,200.
175,200. And how much asset added? 48,000. So addition is a 48,000. 20% depreciation, and we need to multiply it by 6 by 12. How much is that? 9,600, 4,800. 4,800. And the disposal asset, when they dispose on 30th September, up to 30th September, there are 9 months. So against this 84,000, depreciation rate is 20%. We need to charge 9 months depreciation. What could be that?
12,600.
To
12,600. 12,600.
12,600. What is all together?
600.
192, 600. So we'll write here 192,
600.
So let's take a break. After break, we will cover one more. let's move toward new chapter.
Intangibles.
Chapter 9 is intangible assets. There are two types of non-current assets. Non-current assets are of two types. Tangible non-current assets and intangible. Tangibles that can be seen and touched, that physical exist are called tangible, and intangible that cannot be seen or touched, that doesn't exist physically, will be called intangibles. Tangibles we have covered in previous chapters. Plant and machinery, land and building, motor vehicle, furniture and fixtures. Now let's discuss about intangible assets. What are intangible assets? Goodwill, patents, copyrights, not shares. Asset, trademark, development cost. These are different examples of intangible assets. What is goodwill? You can say goodwill is a repute of our business. How goodwill can be calculated? Suppose this is one of my business. Like my business is a college. So this is my business. In my this business, I'm having some assets. Like I have a land and building of say 40 million. I'm having some furniture of say 10 million. I'm having a motor vehicle for a student, say 10 million. How much asset we are having altogether? 60 million. 60 million. This is what called what? Net value of assets. My this college is running very good. I'm generating huge profit from this business. One of the investor asked me, I want to buy your college. I say, okay, I can sell you, but my college is running very good. I'm generating huge profit from this business. Even the future is very bright. I will earn even more profit in future because it's growing day by day. He said, okay, I will pay you 90 million for this business. What is this 90 million? This will be called consideration paid. In cash, he will pay to me will be 90,000. What is the net value of assets? That is 60,000. The extra he is paying what? 30 million. That will be called reputation of the company. Due to repute of the business, due to profitability of the business, due to good position of the business. So how goodwill can be calculated? Consideration paid less net value of assets. Consideration paid less net value of assets, we can calculate what? Goodwill. If the business has the liabilities? Obviously, that's why I have say net value of asset mean asset minus liabilities. What is the net worth? Suppose 60, suppose 50, minus liability of 10 million. Suppose 50 is net value of assets, but he's paying 90, 40 will be goodwill. 40 goodwill for the value of the. What are the patents? copyrights, trademarks. Suppose if I have bought patent, copyrights, trademark of any company like McDonald's, so that I can sell McDonald products. So that I will also record it as intangible assets. What else could be brand? If I have bought any brand name, that will be capitalized as intangible asset. Mean purchased brand should be capitalized as asset. If suppose I have created my own brand, I started a business, I have created my own brand. That is called internally generated brand. That should not be capitalized. We cannot record internally generated brand as intangible asset, but we can record purchased brand as asset, as intangibles. Because what is brand? Any of the slogan like this is the logo of the brand. So due to this, people are paying more for your products. Can we touch this brand? No.
Only just see.
We only can see. So only purchase brand will be capitalized, internally generated cannot be capitalized. Okay, one thing more. The tangible asset, we need to depreciate over its useful life. In the similar manner, intangible asset will also be depreciated over its useful life, but the word depreciation will be changed towards amortization. Tangible non-current assets will be depreciated over its useful life, while intangibles will be amortized over useful life. How? Cost divided by useful life of the asset. We can calculate depreciation, or in similar manner, we can calculate amortization. Let's discuss about it. The development cost we're gonna discuss later on. So non-current assets are assets used within the business on an ongoing basis in order to generate revenue. The purpose of asset is to generate revenue. That's why we are charging depreciation as a cost of asset usage to the revenue. IAS 38, intangible assets is having standard IAS 38, while tangible assets having standard IAS 16. IAS 38 intangible assets define an intangible asset as an identifiable non-monetary asset without physical substance. It is a resource controlled by the entity as a result of past event from which the entity expected to derive future economic benefits. It lacks physical substance, and it is identifiable and separately distinguishable from goodwill. Goodwill is something different type of intangible assets. Other are of different type. These all other except goodwill we amortize. But goodwill we do not amortize because goodwill we cannot measure its life. We cannot estimate the life of our business repute. That's why goodwill is a separate type of intangible assets, mean that will not be amortized. All other intangible assets should be amortized. That's why it has says other than goodwill. So it is identifiable and separately distinguishable from goodwill because goodwill will not be amortized. The basic principles of recognition of an intangible asset in the financial statement is that the asset meet the definition of an intangible asset and recognition criteria. The assets are of two types: tangible, intangible. Tangible normally have physical substance like land and building, normally involved capital expenditure, and the cost will be capitalized and they will be depreciated over their useful life. Intangible do not have a physical substance, can be purchased like brand purchase will be capitalized, internally generated cannot be capitalized. Purchase intangible non-current assets are capitalized. Generally, item generated assets may not be capitalized, internally generated like brands, and they will be amortized. Examples: development cost, goodwill, trademark, license, patents, copyrights, franchises. That's your understanding one. Please solve it. So Wills Limited purchase a patent with a useful life of 10 years for 20,000 on 1st January 20X9. You need to prepare extract of the financial statements. So in profit and loss account, we will record amortization.
Amortization 2000.
How much? 2,000.
Yes.
And in a statement of financial position in balance sheet, we will record intangible asset
18,000.
cost 20,000 and amortization minus will be 2,000. So with 18,000 as patent. Simple. Okay, move forward. Research and development cost. Research cost should be expense out. It should be recorded in profit and loss account as an expense. Development cost capitalized as asset. If meeting certain criteria, if they are not meeting criteria, they should also be expense out. But if development cost meeting certain criteria, they must be capitalized. What could be the criteria? There are 6 criteria. Technical, feasible, commercial, viable, intention to use, complete, or sell, ability to use, complete, or sell, availability of resources, and cost can be measured reliably. If development cost meeting these 6 criteria, development cost should be capitalized as intangible asset. If any one of these 6 criteria is not meeting, it should be treated as expense in profit and loss account. What is research? What is development cost? Suppose we are going to find out or we are going to produce a medicine of corona. Corona is a disease, and we are going to produce any vaccine for corona. How that vaccine will be developed? First, we need to find out the formula for the vaccine. And in formula, what kind of different salts will be used? We need to find out those salts. But for those salts, we have to make some investigation called research. I mean, we need to ask different people. We need to visit different locations. What could be the sorts? What could be the things that can be used, that can be used as a vaccine of corona?
Medicine.
I mean, we need to consult different scientists. We need to perform different experiments on the salts available, whether they can cure corona disease or not. That investigation, that experiments, that consultation with different scientists, if we haven't find any formula, but we have performed investigation, we have performed some experiments, we have consulted different scientists, but we haven't find any formula, so that all cost will be called research cost. I mean, we have performed some investigation, we have consulted different scientists, we have performed different experiments on different sorts, but we couldn't able to find the final formula. So that will be called research. But if through those experiments, consultation, sorts, we have defined a formula through which we can develop a vaccine, so that formula will be called development cost, because now we are able to produce any product. If we have performed investigation, but we were not able to produce any product, this means we have spent the time, we have spent the cost. So all those costs will be called research costs. They must be expense out. But if we have find a formula through which we can develop a vaccine in product, so that will be called a development cost, and that must be capitalized if meeting these 6 criteria. What are the 6 criteria? Technical feasible. Technical feasible mean we can actually produce a product from that formula. If we cannot produce a product realistically, so that will be research. That will be expense out. No, technical feasible. Yes, in reality, we can produce product from that formula. This means this development is meeting this criteria. Commercial viability mean demand in the market, mean the product we are going to produce is having demand in the market. Yes, corona is there, so vaccine will be demanded in the market. If there will be no demand, this means this product we will not be able to sell. This will not provide generate any revenues, will be expensive. And it is the management intention they can use this formula, or they can complete any product, or they can sell products. So this means meeting this criteria, not only their intention, they must have the ability, mean having a different resources, machinery, people who can produce that product. And there should be availability of resources, mean finance should be available. Through this, you can produce the product and you can spend money on marketing. And how much cost will be included in the vaccine product? What could be the raw material? What could be the labor? What could be the other cost? If you have measured that cost reliably, mean actually, realistically, this means this criteria is met. If you cannot measure the cost, you can just making guess. Oh, cost could be for one product either $30 or it could be $18. This means you haven't measured actually. So this criteria will not be met. This means expensive. So research is a investigation without final formula or product. Development, investigation to reach out a formula or product, but will be capitalized, will be treated as an asset if meeting these 6 criteria. Now read, what is this? So IAS 38 contains specific requirement relating to accounting for research and development activities. First, it is necessary to understand the definition of research expenditure and development cost before the respective accounting treatment is considered. What is research? Original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. Mean all the consultation with the scientist or experiments. Mean how formula can be determined. Mean finding different salts. through experimentation. You have 30 shots. So what could be the shot used for corona vaccine? You are finding that shot through experiment. That process is called research. Development is defined as the application of research. Mean after research, you have found a salt. Now you are moving towards developing a formula for the vaccine or other knowledge to plan or design for the production of new or substantially improved material, devices, products, process, system, or service before the start of commercial production or use that you will sell or use. Accounting treatment of research and development cost. When an entity undertake research and development activity, expenditure is incurred with the intention of producing future economic benefit, i.e. increase sales revenue. The accounting issue is therefore whether these costs should be expensed to the statement of profit or loss or capitalized as intangible asset on a statement of financial position as an asset. It depends. Research cost or research expenditure should be written off. Written off mean recorded as expense to the statement of profit or loss account. This is in compliance with the prudence concept. Research expenditure does not directly lead to future benefit and therefore it is not possible to follow the matching concept. All capital expenditure on research equipment, plant and equipment should be capitalized and depreciated as normal in accordance with IAS 16. In all the machinery used in research will be treated as asset, but the cost relating to consultation, relating to experimentation, that will be expensive. Development cost must be capitalized as an intangible asset if they meet the definition of an intangible asset and also meet the recognized criteria. What is the criteria? Probable inflow of economic benefit mean commercial viability, intention to complete the asset or use or sell it, reliably measurement of the cost, adequate financial resources are available. What could be the other? Technical feasible, technical feasibility, and expected to be profitable. If the above criteria are not met, development expenditure must be written off to the statement of profit and loss account. If research expenditure has been treated as an expense, it cannot be subsequently reinstated as an asset. And we need to check the criteria of development cost every year. If in previous year we have capitalized intangible asset as development cost by meeting criteria, if next year it is not meeting any one of the criteria, we need to expense out all the asset. It will not remain as asset. And development cost should be amortized over its useful life. Amortization of development cost. Illustration 1. Bright Spark company is developing a new product, the widget. This is expected to be sold over a 3-year period starting in 20x6. The forecast data is as follows. Net revenue from other activities, mean other than this product, will be 400, 500, 450, 400, mean routine business sales. Net revenue from this widget product will be 450 in 20x6, 600 20x7, 400 20x8, and they have incurred development cost of 900 in 20x5. Show how the development cost should be treated if the costs do not qualify for capitalization, mean not meeting the criteria. In that case, this 900 will be treated as expense. So what could be the profit or loss for these years? For 20x5, 400 revenue, 900 expense. So what could be the profit or loss? 500 loss. Profit or loss. For 20x6, there will be 950 profit 20x7, there will be 1050 profit and 800 profit. Part A is a fine.
But we have to expense out.
Expense out in the year where it is incurred.
Income.
Complete, not over the years. Now part B. The cost do qualify for capitalization and are amortized on a straight line basis. How many years it should be amortized?
3 years.
3 years. So 900 divided by 3 years, 300 every year. This means we need to record 300 amortization here, 300 amortization here, 300 amortization here, and here nothing. So for year 20x5, there will be 400 profit. Here will be 650 profit. Here will be 750 profit, and here will be 500. Is that fine? Instead of development cost, we will call it amortization. So this they have calculated.
Non-current assets in intangible. This is intangible.
This is intangible. We'll write under intangible asset development cost.
Development cost. So
900 will go there. 900 will go there. Where? In 20x6.
20x6.
20x6. Less amortization of 300. Mean with 600.
600. 600 left, then it going forward to
Next.
next.
Okay. Test your understanding too. Which of the following should be classified as development cost? Right. Need to find which should be a development cost.
2 1 for development. Yeah, first one is investing.
Number one, Briny company has spent $300,000 investigating whether a particular substance flubber found in the Amazon rainforest is resistant to heat. Mean they just perform investigation, they haven't found formula or products. So this is not the development cost. This means if one is not, A is not, B is not.
Yes.
This means 3 is also not.
Yes.
So now either only 2 or 2 and 4. So just move straight away to 4. Whether option C or D. Brine company has incurred a further 450,000 using a flubber in creating prototypes. Prototype means sample. of a new heat resistant suit for stuntman mean they have 12 product.
Yeah.
So this means 4 is meeting option C. Let's read 2 whether it is. Clever Claw Company has incurred 120 expense in the course of making a new waterproof and windproof material with the idea that it will be used for sky where they have developed a material not only have performed the investigation. So C option. That's your understanding 3. Try that please. During the current year, Deep Blue Sea developed a new material from which the next generation of wetsuits will be made. New material they have developed. Main development cost. This special material will ensure that the swimmers are kept warmer than ever. The cost incurred meet the capitalization criteria. And by 31st December 20x5 is the year end. 250,000 have been capitalized as development cost. The wetsuit are expected to generate revenue for 5 years. This is the life. So what is the amortization? 250,000 over 5 years. It will be 50,000. Rate of commercial production commence on 1st January 20x6. So what amount is charged to statement of profit or loss? What we will charge to profit or loss amortization because 250 will be capitalized. So 50,000 is amortization. Measurement and recognition of IAS 38. IAS 38 intangible asset says that intangible assets shall be measured initially at cost and shall be carried at its cost less accumulated amortization and any accumulated impairment loss. For the valuation model to be applied, fair value should be measured by reference to an active market. Mean they could be recorded on revaluation basis as a, but will not called revaluation, will be called valuation basis. IAS 38 intangible assets, the financial statement should disclose the following capitalized development cost under intangible asset. Mean there should be disclosure for this as well. The amortization method used and expected life. The reconciliation of carrying amount at the beginning and period mean closing current year figure as well as previous year figure. And amortization during the period mean what you need to disclose. We need to disclose. Suppose companies having two intangible assets, development cost and licenses. So their cost account balance, opening balance, addition, disposal, closing balance, A, and amortization account, opening balance, charge to the profit and loss account, and disposals. Instead of disposal, it should be closing balance. Balance carried down. And this will be B and this will be A minus B. And these are the previous year figures should be disclosed along with current year figures. So chapter is completed now. That's it for today. We'll see next chapter in next class.
So in the tangible and intangible,
Mhm.
which is the most asked questions in the